Hey guys, and welcome to another episode. Naked price action is a superior way to trade, as it allows you to identify what the market will do next by focusing on only one thing that really matters: the price. In this video, we have gathered some of the most interesting price action signals and techniques we found after many years of trading, which actually work on the market. So today, I will show you how to identify these patterns on the chart, the psychology behind them, and how to use them to make a well-informed trading decision. So as always, please hit the like button to support us in making more videos more often, and subscribe if you are new to the channel since we publish many advanced trading concepts. Welcome back, and let's get into the price action signals. Number 1. The inside bar confirmation. Imagine we are in a ranging market where the price has been trapped in a box. Then it breaks and closes above the resistance level, indicating that the buyers have overcome the sellers, and the market can continue pushing upwards. However, how can we ensure this break is valid and not a failed breakout or manipulation? Because the market can easily get back into the range and continue pushing downwards. So one of the ways to validate the break is to wait for a pullback and rejection to indicate that this level will hold. But the problem is that this pullback may never come, and we can lose a great trading opportunity to go long. So this is where the inside bar confirmation comes in. An inside bar consists of two candlesticks. The first is called the mother candle, which is big and large, and the second is smaller and located inside the mother. The inside bar formation indicates a period of indecision in the market. A bullish trend reflects that the bulls are not buying further in the second period, represented by a small red candle on the second day after a strong uptrend. And in case of a bearish trend, sellers are not in control of the market anymore. A small green candle reflects it after a strong movement. How does it help us assess the validity of a market structure break? Well, if an inside bar forms after breaking a market structure, it shows a temporary indecision in the market. And if the price breaks this pattern to the upside, it shows that the sellers tried to push the market back inside the range and they failed. So, it is another confirmation that this breakout is valid, and the price has a higher chance to continue pushing upwards. Here on the US 31 hours chart, the market has rejected this resistance level twice. Then, the market breaks this level and makes an inside bar candlestick pattern, showing that sellers are trying to push the price below the level again. So, if the market breaks the highest point of the mother candle, it signals that the buyers are in control, and this break is valid. So, there is a higher chance for the price to continue pushing upward. Now let's move to the next signal. Number 2, fakeouts. A fakeout, or a failed breakout, occurs when the price breaks through a structure level, but immediately gets back into range. Imagine we are in an uptrend, and the market breaks through a resistance level. So, if the market returns to this area, resistance becomes support, and we expect rejection. But if the market breaks right through, we call this a fakeout, and it indicates a significant momentum on the opposite side of the direction and signals a possible direction change. Here on the Bitcoin 15 minutes chart, the price has recently broken below this support level. So, we expect this area to act as resistance and reject the price to the downside. But this resistance fails, and the price gets back into the range, which shows buying momentum and pressure. So expect the price to continue pushing to the upside. Also, if we check the 1 hour's time frame, we can see that the higher time frame direction is bullish since we have recently broken above the structure level. By considering the higher time frame directional bias and lower time frame entry reason, we could expect the price to move to the upside. Here on the gold 15 minutes chart, we have a fakeout. But the interesting point about this fakeout is that it occurred after mitigating a higher time frame demand area. So, this is a double confirmation that the short-term downtrend is over, and we might witness a reversal. But remember, always be patient. If the trade does not align with your trading plan, you can always pass it. So let's move on to the next signal. But before we continue, if you like us to make more videos more often, don't forget to support us with your likes and comments. Number 3, double top and double bottom entry. A double top or bottom is a popular M-shaped reversal pattern that price action traders are widely using. Whenever a double top forms on the chart, it simply shows that the price failed to create a new higher high, possibly due to various reasons like momentum loss, market structure shift, tapping into higher time frame key level, and more. The most conservative way to trade this pattern is that wait for the price to break the neckline to confirm the reversal. But the problem is if we enter the market after breaking the neckline, our stop will be too large. So the common way to trade this pattern is that wait for the price to pull back to the neckline and look for candlestick rejections to enter trades. But we could also miss the trade if we don't get a good candlestick formation. So this is the way we trade double top and double bottom. We combine this pattern with 618 Fibonacci retracement to optimize our trade entry. After breaking the neckline, we will put the retracement tool, which you can access in the Indicators tab, from the start of the move to the end, and place our sell limit order precisely at the 618 retracement level. However, some of you guys have been asking in the comments, smart risk, when using the retracement tool, how do you know this is the end of the move? The answer is that we will never know. Every time you place the retracement tool, but the market decides to dive deeper, you should adjust the tool with the latest move waiting for a pullback. Remember, if we don't get a pullback and the price reaches our target, there is no point in looking for trade anymore. The same concept applies to the bearish scenario. Price rejects a level twice and completes the pattern by breaking above the neckline. We use Fibonacci retracement tool and place sell limits at the 678 retracement level. Our stop will be below the swing low, and we will target the next level of market structure. But here comes an important point. Trading every double top and bottom in the middle of nowhere isn't effective. The best way to trade is to mark a higher time frame key level that rejected the price multiple times and wait for double top or bottom rejections in the lower time frame. Here on the Euro-Dollar 1 hours chart, we have a major level of market structure that has recently acted as support and resistance multiple times. Now I would like to see that market enters the supply area. Then we will look for a double top reversal pattern to enter a short position. Now let's zoom into the 5 minutes. Here we can see that the market has made a double top, breaking the neckline to the downside. So we put the retracement tool from the start of the move to the end and placed our sell limit at the 618 retracement level. Our stop will be above the swing high, and we will target the next level in front of the price, making it a more than 1-to-2 risk-to-ratio trade. Now, this setup is not limited to this technique, and you could use multiple price action entry reasons to place the trades. For example, this long wick rejection candlestick. But the important point here is that to calculate the results and build the confidence to trade your setup, you should do your own backtesting on multiple pairs. Shrinking candles refers to a situation in which the candle's body is getting smaller and smaller before reaching a supply or demand zone. Here on the chart, price came up, hit, and reversed, giving us a key level of resistance. Notice how the candle's body gets smaller as the price approaches this level. The psychology behind the shrinking candles is that it shows the loss of momentum from the buyers, which results in a smaller distance pushed by the price. It is an early signal that buyers are losing control, and prices might reverse from the area. Now this pattern works best when accompanied by another reversal pattern, like a doji candle or long wick rejection at the end. Remember, the same concept is valid for the bearish scenario. Number 5. Momentum candlestick pattern. The momentum candlestick is a pattern that consists of 2 consecutive candles in which the body of the second one is larger than the first. The psychology behind this pattern is that it shows a heavy momentum entering the market, which signals continuation in the same direction for the price. Now remember that this pattern works best when the larger candle has no wick on the top, indicating that the buyers were pushing till the last minutes of the candlestick period. Also, always consider it a trading opportunity when this pattern aligns with the market trend. Here on the pound-yen 1 hours chart, these are the momentum candlestick patterns on the chart. Now notice how the price rises after this candlestick pattern's form. These signals are not enough tools to place trades based on them, but combining these concepts will help create a well-informed trading decision. Number 5. Rising and falling wedge pattern. A wedge pattern is a period of consolidation where the price forms a condensing structure that could be identified with two trend lines. Now, what does it tell us about the market participants? It shows us that the market does not have a clear direction, and buyers and sellers are fighting to take control. That's why breaking above or below the trend lines shows which side has taken control. Breaking above the falling wedge in an uptrend indicates continuation to the upside. Similarly, breaking below a rising wedge when we are in a downtrend indicates price intends to continue to the downside. But the question is, when exactly we should take the trade? Because sometimes, these breaks could be a fake out, and the price gets back inside the range. Now here is how we approach this trading opportunity. In the bullish scenario first, we need to break and close above the falling trend line and previous market structure. This rule confirms that the market has enough momentum to push to the upside. After this break, we will look for entry reasons and open a buy position. Once again, entry reason could be various price action signals. You could wait for the price to return to the trendline area and look for rejection or candlestick reversal patterns. Here on the gold 1-hour chart, we have a bearish higher time frame directional bias. We can identify this wedge pattern which shows a period of indecision in the market. Then the market breaks to the downside, signaling that the seller has taken control. Also, have a break and close below the previous market structure, which is the second confirmation. Now let's apply the retracement tool and place sell orders precisely on the 618 Fibonacci level. Here on the Bitcoin 1-hour's chart, we have an obvious downtrend. We have a period of consolidation, and we are looking to enter a short position. Now let's zoom into lower time frames to observe more details about the price action. Here on the 15 minutes chart, we see that a rising wedge pattern has formed, and breaking this pattern to the downside signals a possible bearish continuation. Number 7. Combining high-quality signals. The best trading setups are the ones where multiple high-quality signals confirm each other, providing a robust and reliable indication of market direction or potential price movements. This example is where a high-quality trade setup occurred. So let's break down the price action signals we have individually. First, this clear moving downtrend is continuously making lower lows and lower highs, so we want to trade with the dominant trade. Second, we have a key level of market structure that recently rejected the price multiple times. Third, we are at a trend line with multiple recent reactions, which is another great bearish confirmation. Fourth, we have shrinking candles as the price approaches the key level showing momentum loss. Fifth, the market made a double top pattern showing a possible reversal. Sixth, we have a long wick candlestick pattern at the area of multiple confluence showing the reactions to the area. Seventh, we have an engulfing momentum candle confirming the bearish pressure, another great entry reason. So let's check out the list of all the great factors in our favor for this short trade setup. So this is a high-quality 5-star short trade opportunity. So here's an important point. Waiting for high-quality trades and filtering the low-quality ones is an important skill you must develop. So guys, I hope this video has some value for you. If it had, please smash the like button to show your support, and subscribe if you are new. See you in the next episodes.